Should you risk heavy on few accounts or light across many? It's a question every prop trader faces, right? Big risk on one account looks fast, huge payouts if you're right, right? But it also means blowing accounts when you're wrong. Now, spreading risk across multiple accounts might feel safer. You'll get more consistent payouts, but usually smaller ones, right? So today I'll break down how I personally manage this across eval accounts, funded accounts, and my live futures accounts trading markets like NQ and ES, right? Plus, I'll show you the stats on why most traders fail and how to avoid becoming part of that 95%. So let's set expectations with some hard numbers, okay? I looked these up. I made sure I did my research. And at Topstep in 2024, only 12.4% of traders passed their futures combine. And of those 12.4%, only 28% ever made a withdrawal. That's about 3 to 4% overall that ever got a payout. And this is not like they're consistent. They got one payout at one time. So Apex and MyFundedFutures don't publish their exact stats. I still use these prop firms from time to time. Less Apex now because of a thing that happened way back. But industry-wise, it's kind of the same story, right? Across future prop firms, fewer than 1 in 10 traders pass the eval, and only about 2 to 4% of all traders who start ever reach a payout. That means over 95% of traders never see a dollar back. We're not even talking about profitability yet. We're talking about seeing a dollar back. There's people that put thousands into it and got like a $200 payout. Now they got a payout, but are they profitable? No. So prop firms pay out millions every month, right? Apex alone processed like 5 or 6 million in trader withdrawals in 1 month of 2024. But those payouts are supported by tens of thousands of failed challenge fees. They're still businesses, right? Prop firms are here to make money. So before you even think about consolidating or spreading your risk, you need to understand the odds, okay? So why do so many traders fail futures challenge? So they're either over leveraging, right? They're trying to hit 6 to 10% target too quickly. They size up and blow through the trailing drawdown. They ignore their stops. In futures, one bad trade on NQ or ES, right, can easily push past $1,000 daily loss limit if you don't cap it, right? They're trading news. A lot of accounts die on Fed announcements or CPI or NFP or whatever, right? They're emotional. Now, you can be emotional. I always say this, you can be emotional while trading, but you cannot let it affect your decision. We're all human at the end of the day. You're going to be happy you hit TP. You're going to be sad you hit SL. It's normal, guys. Stop saying to not trade emotions. We're not robots. But you need to never let any of those things affect your decision. Okay, revenge trades, doubling down after a loss, all that needs to go out the window. You need to come in with your plan, execute your plan however you feel, right? There's also the time pressure, right? Challenges usually have a profit target with no upper time limit, but traders rush anyways, right? Because sometimes there's a monthly subscription or something. They feel like they need to make it now, or like, might as well get another eval because, next month I'm getting, or next month they're going to charge me again. And the firms know this. That's why they do it. That's why the rules are structured the way they are. The main killer isn't lack of skill, it's risk management under pressure. It's literally what it is, right? Risk management under pressure. So let's say you do pass, right? Now you're funded. You think that means you're safe. But here's the catch. Most funded traders never actually get paid. At Topstep, only 28%, again, of funded accounts withdrew in 2024. That means nearly 3 out of 4 traders lost the account before the payout, right? They got the excitement of passing the account, but they never made the payout. Why? Because they don't change their behavior. They trade their funded accounts like it's an eval. They keep swinging for the fences, and the trailing drawdown wipes them out. All right. I've seen this with NQ, especially. Now, I trade NQ more than ES, but NASDAQ has massive intraday swings and thinner liquidity than ES. A 50-point move against you on NQ can mean slippage that hits you harder than you expect. I'll just take today, for example. I took an L today. I had a $650 SL on my funded, on my eval, sorry. And I took a $830 loss. My stop loss was at 650, but I lost 830 on that trade. ES, on the other hand, is steadier and more liquid, so fills are usually cleaner and risk is kind of smoother. It's more of an NQ thing. The data also backs this up, guys. Futures prop firms consistently see higher blow up rates in Nasdaq accounts compared to the S&P. NQ tempts trader with big wins. That's why there's more points, there's more moves. But it's also the fastest way to break your risk rule, right? So be very careful with what you trade and make sure you're a specialist in the asset that you trade. Now, I trade NQ. I'm profitable with it, and it works for me. Some people can't trade NQ. They stick to ES. That's fine, right? We don't have to be the same person. We all have our differences. This is why I always say you can take a strategy on the internet, but please tweak it to your liking so that it fits how you are as a person. Anyways, I'm getting off topic. Let's talk payouts, all right? Because this changes how you think about risk a little bit. MFF is usually competitive splits and fast payouts, right? Apex traders keep 100% of the first like 25 or $10,000 per account, and then it's 90-10 after that, and payouts are available every like 8 trading days or something. I'm going off the dome here, so please forgive me if my info isn't super right. But Topstep traders keep usually 100% of the first 10K if I'm not wrong, and then it's 90-10 after. So those are great splits, but remember, guys, the average first payout across firms is only like 2 to 5K. So smart traders don't just pocket that; they use part of it to fund more evals, and that's how you scale. One account becomes two, two becomes four, four becomes five, six. Some firms even let you run up to 20 accounts at once using trade copiers like Replicanto and a few more. That's how you turn small payouts into kind of like a meaningful income, right? And that's how you can kind of make a living from it. So here's how I personally do it trading NQ and ES. Now, it hasn't always been this way. If you guys want a full story time of how I actually ended up scaling, I can do that video for you guys. Just comment down below that that's what you guys want to see. But right now, as of today, how do I go about my risk? So evals, I risk 1.5 to 3% per trade. The goal here is speed. The goal with the eval is to pass it as fast as possible, not gambling it, not a one trade risk all, but like 2, 3, 4 trades around there, right? If I fail, it's no big deal. I'll buy another eval with one of my funded payouts. I'm not worried about it. So usually I go for either a 2, 3, 4 trade past the eval. On funded accounts, I risk 0.5 to 1% per trade. Here, the goal is consistency, right? This is where I get my payouts that I recycle into more evals and slowly scale up. The goal on funded accounts is not to get moved to live. I've been moved to live before, and that's not good. You rather stay on the funded account, all right? Because profit, once you start getting too profitable, they move you to live, and then it's a whole nother ball game there. And on live account, I risk 0.5% and sometimes a little less, and I'm very picky with my setups on there. Goal here is capital growth, not payouts, right? This is long-term money. So I'm always operating 3 accounts or 3 layers at once. My evals, which is kind of like a disposable sprint, my funded, which is my consistent payout, and my live, which is just protected compounding. And that way, I never rely on just one account for everything. Now, if you guys watch me live train in my free Discord, you're always on the screen, you always see the eval. But sometimes I'll say, oh, I entered this on my funded too, or oh, I entered this on my live too. And if I enter it on a live account, that's how you know this trade right here is A+++. All right? So let's put this shit into numbers real quick. On a 50K eval, risking around 2% per trade is $1,000. So 2, 2.5, 3 losing trades, and you're done. It's usually 2 to 3K to draw down. So you could risk $750 to $1,000 per trade, and it'll take you a little bit of time to pass the account, but not nearly as much as the rest, like 2, 3, 4 trades, like I said. And I accept that because the goal here is speed. Okay, on a 50K funded account, risking 0.5% per trade is $250. Right, to lose like 6% or 8% that you need to lose, which is like around again 2 to 3K. You need like 10 losing trades in a row, which is much safer than the eval, right? Again, and on my live account, it's even tighter than that. Maybe go to 250, but that's about the max out risk. Sometimes 200 is usually what I'll risk on my live account, and only on A+ trades. Okay, I can take 1 trade a week on it, 2 trades. I don't care. This is how I compound my account. It's like a retirement fund. This is not what I use to pay bills at all. Okay, and this balance is why I'm always building, always cashing out, and always protecting capital. My live account is over 6 figures, and I'm still only risking that small amount. Why? Because I don't need to make a huge amount of money on it. My payouts come from funded accounts, which is less risk for me, and my live account is just slowly compounding over time. Okay, so instead of just asking should I consolidate or spread risk or whatever, think about the purpose of each account, right? Your eval is your sprint, take risk, pass fast. Your funded is your payout, protect them, recycle into new accounts, and your live is your long-term growth. Be picky, compound it. Like this only applies, by the way, to like a situation of which I am in, which is I have fundeds, I have evals, I have all this stuff. If you're just starting out, I have a video on how to pass eval, which is about slowly passing it. Now, once you have the first funded, then you can start doing what I'm doing right now. Okay, but it's important to understand that if you're just starting out, don't go risking heavy on evals. Start practicing the skill, the action, and actually get funded using the right risk management tools. and then take more of your time with it, I guess is what I'm saying, and then you can move on to what I'm doing now, which is an eval, a funded, and a live account. I used to only trade my live account. I started doing this recently, and I really, really love it. If you don't want to have a live account, that's fine. You can use a bunch of funded accounts, get your payouts, pocket some of that, put some of that into a high yield savings account or something, real estate, whatever you want, and then buy some evals on the side. It's really good to buy evals. It's a great time to trade right now because of the prop firm. Because if you know what you're doing and you can take advantage of it, taking $100 and turning it into $5, $6, $7,000 on a payout is actually the best ROI you could ever find. Like other than like a crypto meme coin that like you're gambling on basically, right? So this way you're not just playing games. You have a game that the prop firm kind of set up for you. You're building a system that feeds itself type of thing. And yeah, so basically that's about it, right? What about you guys? Do you risk heavy on a few accounts or spread it across many? Drop your approach in the comments below. I'd love to compare strategy with you guys. If this helped you, hit that like, subscribe, join the free Discord, ring the bell to be notified, and the link to my free Discord is in my bio, by the way. I'll catch you guys later.